Welcome to my channel today. This is King's Tutor. If it's the first time of joining us, please like, comment, share, and subscribe to our channel. Okay? Now today we want to see the cost. We want to see cost in economics. Okay? We're going to look at different aspects, the cost concept. Now we're going to see explicit versus implicit cost, money cost versus opportunity cost, short run, long run, economics view, and accountant view of cost. Now what is cost? A cost is the sum total of payment made to the factors of production. Okay? Or cost can be seen as the sum of all payment made or incurred towards what? Production. Okay? A cost of an enterprise. Now, we want to see that cost concept. We have different aspects of cost concept. Now, the first one we look at is what we call the fixed cost. For the cost concept. Now, what's a fixed cost? A fixed cost, which is also known as unavoidable cost, is the cost of an enterprise that do not change with output. They remain constant, irrespective of the level of output. They are the same. Okay? They do not change. Example is salary or rent. Okay? So, a fixed cost can be seen. The formula for the fixed cost is total cost minus variable cost. Okay, total cost and variable cost will give us fixed cost. Okay, most time the cost schedule in an examination, they will ask you what is the cost, or they want to know the fixed cost. The fixed cost is the cost in the cost schedule that remains the same, that do not change. Okay, so the next one is the variable cost. The variable cost. And the variable cost is the cost of an enterprise. It's also known as direct cost. It's the cost of an enterprise that change with the level of output. That is, if output is increasing, they are also increasing. If output is decreasing, they are also what? Decreasing. They change with the level of output. It is the output that determines how their cost will be. Okay, for example, direct materials that is used. For example, if a firm is into the production of juice, fruit juice, oranges will be a variable cost because oranges are used for to make juice. Okay, and also the formula for the variable cost is VC equal total cost minus fixed cost. Okay, the variable cost is total cost minus what? Fixed cost. While another one is the total cost. And what's total cost? As the name implies, is the summation of all costs that the enterprise incur within a particular period. In other words, it is seen as the summation of the fixed and the variable cost. Okay? So, the total cost is summation of fixed and variable cost. That fixed plus variable cost is what? Total cost. Now, we also have another one called the average cost. Now, the average cost is also known as average total cost. Take note. It is the cost per unit of an output. Whenever you hear average, we're talking about the mean. Okay? It's the cost per unit of what? An output. So, mathematically, it is given as average total cost or average cost. They mean the same thing. It is given as total cost divided by quantity. The total cost divided by quantity is the what? Average cost. Okay? We also have another called the average fixed cost. That's AFC. Now the average fixed cost is the fixed cost per unit of an output. Okay? And it is given as fixed cost over quantity. Is the average fixed cost. We also have another called the average variable cost. The average variable cost is the variable cost per unit of an output. Okay? And it is given as average variable cost equals variable cost over quantity. That's what the average variable cost. Now we also have another called the marginal cost. As MC. Now what's marginal cost? Now in my previous video we saw marginal expected. Whenever you hear marginal, we're talking about a change. The marginal cost refers to the additional cost incurred in producing extra units of an output. Okay, additional cost. So the marginal cost is seen as change in total cost over change in quantity. And this change is new total cost minus old total cost divided by new quantity minus old quantity. So that's the marginal cost. So these are the various formulas for the cost concept. Okay, ensure you get close to it. So I'm going to set an example using a typical example solution to solve this. Now let's go to the explicit versus implicit cost. These are different aspects of cost. Now what are explicit costs? These are costs that is incurred directly to get item that is used towards production. For instance, the cost incurred in getting materials that can be used towards production is called explicit. They are external to the organization. Okay? While implicit costs are those costs that are directly incurred by the owner of the business. Okay? It is also known as imputed cost. We call it cost of using owner's resources. Okay? So that's explicit. Explicit is the external, while implicit is what? Internal. The next one is the money cost versus opportunity cost. Now, what is money cost? Now, the money cost is that cost that is seen by an accountant. Okay? They view it in terms of the actual expenses. Most time, when we have scale of preference. Okay, what is scale of preference? The list of individual ones in the order of priority. When we have scale of preference, the ones that will actually incur, the expenses actually incurred is called the money cost. While the ones that was foregone, the alternative foregone is called the opportunity cost. I've done a video where I show the difference. You can check that in the description below. Okay? So the money cost is the actual expenses incurred. It is known to one accountant. While the opportunity cost is alternative foregone, the ones that are left unsatisfied, it is known to an economist. Okay? The next one is the short run versus long run cost. And what is short run? And the short run cost is a planning period so short that the firm cannot vary its factor input. Okay? In the short run, some of the firm factor, some are fixed, while some are variable. Take note, the planning period is short that the firm cannot vary its input. Some are fixed, while some are variable. While the long run is a planning period long enough for the firm to vary its productive resources. In the long run, all the firm's resources are variable. That's the difference. For short run, some are fixed, some are variable. Or in the long run, all of them are variable. The next one is economist view and accountant view. The economist view cost in terms of opportunity cost. We've said that before. While accountant view cost in terms of the money cost. Okay, so this is cost. Now we're going to see a typical example where we have figures we're going to use to solve cost using this formula. Okay, so if you have any questions, you can drop it in the comment section below. If you're the first time of watching this, please kindly subscribe, like, comment, and share this video. Thank you.